All right, so let's have her take $40,000 out this time. So what you'll see here is when she just had $36,000 in income, she had no taxes, all right, because again, it's Social Security, it was a bulk of her income. When she took a $25,000 distribution, added to Social Security, added to her pension, she had $3,724 of taxes. Let's do what it looks like if she does $40,000. Let me get my, here we go. All right, so now we got, so we already know that she has $30,000 Social Security. So we know $15,000 is going to be going into the provisional income calculation, plus a $6,000 pension, plus the $40,000 distribution. All right, so this gives us a, what's that, 46, wait. That's 55, 61,000, right? So 40, 55, 61,000 is provisional income. I got a feeling 85% of her Social Security is going to be subject to taxation now. The first 25,000 tax-free. The next 9,000, 4,500 is subject to taxation. And then, see, 61,000 minus 34 is 27,000. That's 85%. Let's take a gander of my trusty calculator. Right, is that 61, that's 34. Yeah, that's right, 27, okay, cool. 27,000 times 0.85. 22,950 is subject to taxation. Yeah, so 85, let's see, she has 30, all right, so basically, bear with me just a second. She has 30,000 total of Social Security. The max you pay is 85%, 25,500, okay, yeah. So this will be more than what, the max you pay on Social Security, the taxes, the max amount of your Social Security benefit that's subject to tax is 85%. So in this case, she's gone above the max, so we know that 85% of her Social Security would be subject to taxation. All right. So in this case, she'll pay the max tax on Social Security as the law allows. So now we got to figure out what her total income is, her AGI, and we take $30,000, that's her Social Security benefit, times by 0.85, 25,500. All right, so 25,500 plus her pension plus her IRA distribution. That's 50,000, 60,000, 75,500. All right, so that's her AGI. All right, yeah, this can get pretty ugly pretty quickly, actually. The first $10,000 taxed at, oh no, we need a standard deduction, excuse me. I forgot to do the standard deduction. And look, don't get too anal on me here. It's not, the total tax code is $9,875. I'm just using $10,000 because it's easy. The standard deduction, I don't even know, I think it's $13,600. I'm just using this because it's easy. Nice round numbers make it easy. So we got 62,500. That's her taxable income. All right. The first $10,000 is 10%. The next $40,000, it goes up to $40,000. So the next 30,000 times 12, and then 22,000. 55. Yeah, that's right, man. 22,000 times 0.22. Because basically the first 10,000 is 10%. The next up to 40,000, which the next 30,000 is 12%, and then up to 85,000 is 22%. Okay, so yeah, this is gonna be ugly. So let's take a gander what we're looking at here. So we got, that's 1,000. We know this is 1,000. All right, so we know that's $1,000. Now we got to do 30,000 times 0.12. Is that 1,600? 0.12. Oh, 3,600. Wow, Oosh, that was way off. 3,600. Oosh, yucky. All right, now we got 22,000 times 22%. Is that 4,400? Times 0.22. Yeah, 4,800. Jeez, I'm not anywhere close to being right. So 4,840. So her total taxes here are plus 3,600 plus 1,000, 9,440. Yeesh. 9,440. right, so basically, in this case, by her taking an extra $15,000 out of her IRA, she paid 9,440 minus 3,724, $5,700 by her taking an extra $15,000. That's a divided, so that's a 38% tax bracket, effective tax. Does that make sense? There you go. Good job. Good boy. So by her, I mean, think about that. By her taking $25,000 from her IRA is a $3,700 tax hit. By her adding another $15,000, it made her tax hit go to almost triple that. So $15,000 more equals a $6,000 more in taxes. And that's $6,000 in taxes more. And you can, basically about $6,000. You divide that into the increase you took from her IRA, that's a 38% effective tax rate, even though she's only in the 22% tax bracket. That's what I'm talking about, man. It's crazy. That's a tax torpedo. And if we go back to, she took $40,000 out, she paid $9,440 in taxes. When she did take that, so then you can even look at it like that, from not paying any taxes. So we take $40,000 of income she took out, divide that by 9,440. Oops, $40,000 of income. What does it do? Oh, 9,440 divided by 40. There you go. That's a 23% effective tax rate, which makes sense. So I mean, so basically, she's in a 22% tax bracket. So by her taking going from 0 to 40, it's an effective 22% of tax rate, a 23.6%, and that's fine because she's in the 22% tax bracket. But if she would have kept it to $25,000, she would have only been $3,700 in taxes. But because she went above that to $40,000, that extra increase in $15,000 cost her an extra $6,000 in tax. Take $6,000 divided by 15, that's a 38% tax hit. It's ugly, man. So you got to know these numbers. If you don't have much income, other than Social Security and a small pension or something like that, you got to know these numbers before you just start willy-nilly taking money from your IRA. Because if you don't do it right, you could really kill yourself from a tax perspective. And if she just does, instead of doing this one fell swoop, just wait till next year. So do $25,000 this year, $25,000, which is pretty much what I told this lady to begin with. 25 this, 25 next, 25 next. And then, by the time she's 72 years old, she'll have 5 years of $25,000. She'll have basically half of her 401k distributed. So her RMDs won't be much at all. Anyway, that's what you should do. So think this through, my friends. It's a big deal, and you got to know what you're doing, because if you don't, you're just paying more to the government. And you need the money. You've already paid enough taxes. All right, we'll see you.